well, let's settle this, guys. We're going to talk to two of the smartest minds on Wall Street. One is a bull, and the other, of course, is a bear. Doug Kass is the bear and president of Seabreeze Partners. He's also a big friend of the show. Welcome to him. Peter Schiff of Euro Pacific Capital is the gold bull. Surprise there? Well, he has said that gold could hit $5,000 an ounce in the next 2 years. Very bold call. He also has a great article on gold at europac.net if you're interested in reading it. Gentlemen, thank you to both of you for joining us on the show. Let's start with the bull. Peter, you know, these past 2 days must have been pretty tough for you. Are you still bullish, and did you buy gold during the sell-off?
Well, I am buying. In fact, I even bought some more gold stocks just for my own account. But I look forward to buying opportunities. I've been buying gold for about 12 years now, and I always buy more when the price is declining because I'm confident that the price is going to continue to rise. You know, people are talking about the fact that this gold sell-off somehow validates that the crisis is over, that maybe Fed policy is working. Not at all. I mean, I'm confident that everything the Fed has done, everything the government has done, has simply exacerbated all of the problems that led to the 2008 financial crisis, that we're in even worse shape now, and I think there's a bigger crisis coming. And I don't think central banks net are going to be selling gold.
Bigger crisis in the form of what?
In terms of a currency crisis, a sovereign debt crisis in the United States. You know, we didn't solve the problems, we just postponed the pain. But I wanted to get to the point about these central banks. Net, I think central banks are still going to be big buyers of gold. Some of the broke nations in Europe may be selling their gold, but there's a lot of creditor nations that have, you know, trillions of dollars collectively in reserves that are going to be looking to move more into gold. So I don't think this gold is going to be sold in the market. I think it's going to be scooped up by other central banks looking to unload dollars and buy more gold.
Doug, you jump in, and what do you think about Peter Schiff's argument?
Hey, Pete, how are you? It's been a long time. The last time Pete and I were together was on almost weekly on the Kudlow Report, where we were talking about an economic abyss in 2008, and we were laughed off the stage, Pete. I enjoyed your piece, too, that you wrote, Gold's Decline, a Minor Dip in an Ongoing Rally. But I think you focus too much on this drift of the global economy in which the wealthy central banks in China, Russia, Indonesia, etc., India, would be buying it at the expense of people like Cyprus. I would start by saying, unlike Peter, I'm not joined at the hip to gold. Peter does thorough work. He's committed. But I see it as just another asset class to choose from, and I'm not emotionally tied to it. In essence, to me, the gold market is a state of mind. It doesn't represent a fractional interest in a corporation like Procter & Gamble, which increases its value over time as profits are earned and retained. It has two significant shortcomings, Pete, to me, as Warren Buffett once wrote. It's neither of much use nor is it procreative. It doesn't create a stream of income. It's basically purchased by buyers in the hope that someone else who knows that gold will forever be unproductive will pay more for it in the future. And I think that you should be focusing less on the central bankers and more on the marginal sellers, as it turns out, and those being traders and investors who have over-owned the commodity, have seen technical erosion in the price of the commodity since September of 2012, which ended in a panic yesterday.
So what is its point,
Doug,
Peter?
that gold might have been over-owned by speculators, but I think it's under-owned by real investors and by savers around the world. I don't
know how you prove that.
Well, I don't look at gold as
that might be your opinion, Pete, but I don't. You tell me how you prove that.
Yeah, because see, I don't look at gold as an asset class. I own assets. I own plenty of stocks. I invest in stocks all around the world. I don't look at gold as a substitute for stocks or real estate or bonds. I look at it as an alternative to dollars, euros, yen. I look at gold as money. And I think more and more people around the world are going to rediscover that gold is money, and these fiat substitutes are not. There are a lot of people that want savings. They don't want to buy assets.
I understand, Pete. I understand your point of view. Where I disagree is that I see the macro tail risks, which you're concerned about. They've been reduced as we experience this global easing from nearly every central bank around the world. Even Washington, it appears, is less dysfunctional than many of us thought. The dollar is stronger, and concerns about our currency from our monetary policy is reduced. Inflation is falling.
The dollar is hitting a 6-week low today. I don't know where you're saying the dollar is strengthening. And
I'm looking at the dollar from late 2012.
Well, but just look at it recently. In fact, the dollar index is almost near what the old record lows used to be. But when you say the risks have been abated, they've actually been exacerbated. I mean, we have more risk now, because what's going to happen when interest rates go up? We have so much more debt now in the system, and when interest rates go up, we're much more vulnerable to that kind of shock.
I wish you were correct.
Won't that be for some time,
I wish you were
Peter?
correct in your forecast of rates going up, but because I'm short the bond market, but they're doing exactly the opposite, as you know. The yield on the 10-year U.S. note has gone from 2.06% to under 1.70% yesterday.
Yes, but it's all artificial. The Fed is printing money to buy up those bonds. Eventually, they're not going to be able to do that anymore, because the dollar that is weakening right now is going to continue to weaken. It's going to push up prices. The Fed is eventually going to be forced to let interest rates go up. They're going to go way up, and then this whole phony economy that's built on a foundation of cheap money is going to topple.
Peter, what timing are you putting on that scenario?
I wish I could tell you exactly when it's going to happen, but that I can't do. But I know we're living literally on borrowed time.
Pete, are you totally indifferent that the price of gold has gone from $1,800 an ounce in mid-September to $1,372 today?
No,
and if
I'm
you
not
are,
indifferent.
then you must be recognized as a perma bull on gold.
No. I've been bullish for a long time, but I don't think that means I'm a perma bull. If the fundamentals actually changed that have been making me bullish on gold for the last decade, if they actually changed, then I would change, but they haven't.
But
the
Peter,
fundamentals that started me buying gold when it was under 300, those fundamentals are still here. The Federal Reserve is doing exactly what I thought they were going to do, which is why I've been buying gold all this year.
Let me ask you one final question. My problem with gold also is my inability, because of my description, that it doesn't hold a fractional interest in an income-producing corporate asset like Procter & Gamble or Goldman Sachs.
I'm not telling you not to own Procter & Gamble. Yeah.
Excuse me?
I'm not telling you not to own Procter & Gamble, but why do you like the U.S. dollar?
Well, my problem is my
gold?
problem with gold has gone from $1,800 to $1,370. I cannot establish an intrinsic value worth of gold. Can you? If you can, then you know where to buy it. It to me is analogous to the internet stocks in 1998, 1999. The reason I avoided them is I couldn't tell if Yahoo was cheap at $180, $90, or $45, and it ended up going to $5.
Look,
just very
I
quickly,
avoided
Peter.
them too, but I can tell you the dollar is less valuable than any of those internet stocks. You keep talking about why you don't trust gold. Why do you trust the Federal Reserve note? Why do you trust a little piece of paper that they can create as many as they want? I mean, how is it any different fundamentally than the Zimbabwe dollar?
Just very quickly, Peter, just to clarify, you made that call, very bold call of $5,000 for a troy ounce in a couple of years' time. Are you sticking to that?
Yeah, I think gold is going to go higher than 5,000. And, you think gold is falling quickly now. Wait till you see how fast it rises when people panic in gold. When so many people realize that they made a mistake, they don't own enough gold, that these paper currencies are losing value, and people are going to look for a store of value, and there's not going to be any sellers. When the people who really own gold, they want to buy it, people like me are not going to be selling it to them.
And Doug, where would you see gold in a couple of years' time?
I can't tell you where it's going, because I think gold is like religion. Either you believe in God or you don't. Either you believe in gold or you don't. And
it's about believing in economics, in supply and demand. It's about knowing history, Doug. This is not just
supply and demand brought you a decline from 1,800 to 1,370 since September.
What are you going to
and from $1,900 in September of 2011. So I think you're dismissing supply and demand.
Okay,
what are you going to say when it makes a new high? Are you going to change your mind?
I'm going to say you were right, but so far you're not.
We'll have you both back on.
I've been
but
saying
I still love you, Pete.
Since it was under 300. How am I wrong every time it pulls back? It pulled back in 2008 by 35%, and people were saying the same thing. You see, you were wrong. Look, gold went down. Then it went to 1900.
We could debate this all day, but we're going to leave it there, guys. Doug, Pete, always great to have you on the show.
Thank you, Peter. Thanks, Mandy.
Okay, Jim Uriah, let me